What if losing your husband or wife didn't just break your heart, but completely destroyed your family's financial future? Most people think life insurance is only about replacing someone's paycheck, but that's only part of the story. Because when you lose a spouse, you often lose far more than just income. Spouse life insurance exists to protect everything your husband or wife contributes to the household. That contribution might be a paycheck, or it might be childcare, transportation, caregiving, and keeping everyday life organized. Either way, replacing those responsibilities overnight can become incredibly expensive. So what exactly is spouse life insurance? It's a life insurance policy where your spouse is the insured person and you're usually the beneficiary. If something happens to your spouse, the insurance company pays the agreed benefit to help your family stay financially stable. Some people buy an individual policy. Others simply add a spouse rider to their own life insurance. The right option depends on how much protection your family truly needs. But understanding the structure is only the beginning. The next question is how spouse life insurance actually works and when it truly makes sense. So how does spouse life insurance actually work once the policy is in place? When your spouse is insured and the policy is active, the insurance company pays the death benefit after an approved claim. Most families name the surviving husband or wife as the beneficiary, giving them immediate financial support when it's needed most. Premiums are based on familiar factors like age, health, coverage amount, and the type of policy you choose. Some applications only require a few health questions, while larger policies may include a medical exam. Ownership also matters because the policy owner controls beneficiaries and important policy changes. That's why beneficiary information should always be reviewed after marriage, divorce, having children, or major life changes. Next comes one of the biggest decisions. Which type of spouse life insurance actually fits your family? Term life insurance is often the simplest and most affordable option for protecting your spouse during your highest financial responsibility years. It works especially well while raising children, paying off a mortgage, or building retirement savings. Permanent life insurance works differently. It can provide lifetime coverage and may build cash value, but that added flexibility usually comes with higher premiums. But buying the right type of policy is only half the decision. The real question is, when does spouse life insurance actually make sense for your family? So, who actually benefits the most from spouse life insurance? If your husband or wife earns income that your household depends on, the answer is usually straightforward. A death benefit gives the surviving spouse time to adjust, continue paying bills, and avoid making rushed financial decisions during an emotional period. But even if your spouse doesn't earn a paycheck, that doesn't mean they don't provide enormous financial value. Childcare, school transportation, meal planning, caregiving, and managing the household all have real replacement costs. Replacing those responsibilities with paid services can cost thousands of dollars every month. Spouse life insurance also becomes especially valuable when you share a mortgage, loans, business obligations, or children who depend on both parents. Of course, not every family needs a separate spouse policy. If your household already has enough savings, existing life insurance, or survivor benefits to meet every financial need, additional coverage may not be necessary. Before buying any policy, calculate the real financial gap your family would face. Not just today's income, but the cost of replacing everything your spouse contributes. If you're ready to compare spouse life insurance options, get a free quote from Quote Maestro today.